Apple just posted its best June quarter ever, and in the same breath warned about a 100-year flood on memory prices that's about to hit margins hard. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Apple, ticker AAPL, for the third quarter fiscal 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. So on the top line, revenue came in 0.5% above the estimate. That sounds tiny, but look at the underlying growth. Revenue jumped 16% year over year to $109.4 billion, and that's a June quarter record with double-digit growth in every single geography. On EPS, they reported $2.02, about 7% above the estimate. But here's the catch. Roughly 11 cents of that came from tariff refunds, which management called out. Strip that out and the clean EPS was closer to $1.91, still up about 22% year over year, which is genuinely strong. So on the beat itself, and remember we're grading against the clean numbers, not the tariff refund inflated headline, this earns a C. A clean 7% EPS beat and a 0.5% revenue beat is a solid quarter, but it's a modest beat by the size standards we grade against. But on consistency, this is where Apple shines. They just don't miss. Quarter after quarter, they land at or above expectations, and this print keeps that streak alive. So consistency earns an A. The demand story is just impressive. 16% revenue growth to $109.4 billion, a June quarter record, and every single geography grew double digits. That includes Greater China, which had been a worry spot for a while. And that ties into the product story. iPhone up 22%, Mac up 29%, and Apple actually gained global market share in both categories, according to IDC. That's happening while they literally cannot make enough product to meet demand. On top of that, services set another record at $30.7 billion, and they crossed 1.5 billion paid subscriptions. The installed base is now over 2.5 billion active devices, an all-time high across every product category. Now on margins, the headline was 50.1%, but even stripping out the tariff refund benefit, the clean gross margin was around 48.1%, and clean EPS still grew 22% year over year. That's a genuinely strong profitability story. And they returned $33 billion to shareholders this quarter alone, with $147 billion in cash on the balance sheet. The capital return machine is running at full speed. So on profitability, this earns an A-. Clean 22% EPS growth, record operating cash flow, and margin expansion on the clean numbers, all at massive scale, is about as good as it gets. The only reason it's not a straight A is the memory headwind that's about to hit. The September guidance calls for revenue growth of 9 to 11%, which is a roughly 5 percentage point deceleration from this quarter. Part of that is currency, but a big part is supply constraints that management said will get significantly worse next quarter. And the bigger issue is margins. September gross margin guides to 47 to 48%, and on a clean basis, that's about a 1.5 percentage point compression sequentially. Cook literally called the memory pricing situation a 100-year flood, and he warned it gets worse beyond September. iPad revenue actually declined 6% year over year, and services growth decelerated from 16% last quarter to 12% this quarter, with some softness in mobile gaming on the App Store. When Cook was pressed on the supply issue, he admitted the problem is that Apple's own demand forecast on advanced node chips was too low. That's a genuinely unusual admission from a company that's famous for supply chain mastery, and they've already reluctantly raised prices on iPad and Mac to manage it. And the regulatory picture is still messy. Siri AI is not launching in the EU on iPhone or iPad at rollout. The US App Store is still under the court-ordered link-out ruling, and China Siri AI approval is at the very front end of the process. So on guidance, this lands at a C+. The September revenue decel is real, and the clean margin compression from memory is a genuine headwind that's going to pressure December EPS, even if revenue holds up. And on red flags, I'm at a C. The memory 100-year flood, plus the untested price elasticity on iPad and Mac, plus the EU Siri carve-out, are three real concerns stacking up at the same time. None of them break the thesis, but together they earn a middle grade. Putting it all together, Apple delivered a clean June quarter record with a strong demand backdrop and market share gains. But the September setup introduces a genuine margin headwind on memory costs that Cook himself called a 100-year flood. This is a high-quality company running into a temporary but real profitability squeeze, and that combination changes how I'd play the next 90 days without changing the long-term thesis. My grade for this print is a B-. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. Apple's a strong company with a temporary headwind on margins from memory pricing, and that's actually a decent backdrop for me to start a new position. If I'm getting in through cash-secured puts, I want to sell them right after earnings, while implied volatility is still juiced up, because that premium collapses fast. What I won't do is chase strength going into the September quarter, because a soft revenue outlook plus margin compression can produce a weak reaction even on inline numbers. So my play is simple. I wait for a memory cost pullback before I make my move. My strike floor needs to survive a rough scenario, where September revenue lands at the low end of the 9% outlook, and December gross margins come in below the 46.5% midpoint, which together could mean a 10 to 12% drawdown. I'm sticking to 30 to 45 day expirations, so I capture the September earnings volatility crush without straddling 2 guidance events in one premium sale. If I go closer to the money, it's only because I genuinely take the shares and roll into covered calls afterward. Bottom line for me, I sell strikes I'd truly accept assignment on. This print doesn't break my ownership thesis, it confirms it, with record upgraders, share gains, an installed base at an all-time high, and services above 1.5 billion paid subscribers. The only reason I'd trim is if I'm overweight relative to my target allocation, and the memory cost overhang gives me a legitimate excuse to pare back into any run into the September print. I'm not adding here because the December quarter will show whether the raised iPad and Mac prices hurt unit demand, and that's the data point I want. For me, it's straightforward. I hold, and I don't add into strength. The September revenue outlook puts a natural cap on the stock for the next 60 days, and that's actually a favorable setup when I'm writing calls against my shares. I'm rolling my expiring calls out to 30 to 45 days and using strikes a bit closer to the money than I normally would, because the memory cost story caps near-term multiple expansion. If any of my existing strikes get challenged, I roll them up and out instead of closing at a loss, because volatility expanding into the September event lets me roll for a credit. For my covered calls, I sell shorter, tighter, in a favorable setup. The print validates my multi-year AI-driven upgrade cycle thesis, with record upgraders on iPhone and Mac, strong beta feedback on Siri AI, and the installed base compounding above 2.5 billion devices. The memory cost cycle is a 2026 gross margin issue, not a 2027 or 2028 thesis breaker, so my long-dated calls with 12 to 24 months of runway can look right through it. If I'm thinking about adding to leaps, I wait for a memory cost-driven pullback rather than averaging up into strength. My stance on the long-dated calls I hold, and I look past 2026. If I'm underwater going into this print, the thesis is validated, not broken, because record iPhone and Mac growth, global share gains, and an installed base at an all-time high are exactly what the long thesis needed. Any add I make gets anchored to a level that reflects the December gross margin scenario, somewhere around 46 to 46.5%, being priced in, rather than me chasing strength into the September print. I don't average down mechanically. I wait for a specific memory cost headline pullback, because this setup rewards patience over aggressive accumulation. My rule for adding here, I add only on memory cost weakness. Bottom line, this print earns a B- from me. The demand story is unambiguous. The margin story is the thing to watch, and that's the balance I'll be working with as I build my game plan for the next quarter. Thanks for watching.